The trader you become. Why traders move their stop loss. Most traders believe moving a stop loss is simply a discipline problem, but often it is something much deeper. Because many traders do not move their stop because they intentionally want to sabotage themselves. They move it because emotionally, the discomfort becomes too difficult to tolerate. Sometimes the discomfort is taking the loss. Sometimes the discomfort is losing unrealized profit. Sometimes the discomfort is the fear of fast volatility and impulsive movement. And once emotional pressure exceeds tolerance, behavior begins changing automatically. That is one of the deepest psychological battles in trading, because traders often believe they are managing risk. But many times, they are actually managing emotional discomfort. That distinction changes everything. Before entering a trade, most traders believe they accept the risk. The stop loss looks reasonable. The setup makes sense. The structure feels valid. The planned loss amount feels acceptable intellectually. But real emotional acceptance is not tested before entry. It is tested when price begins moving toward the stop. That is when the nervous system reveals the truth. Because once discomfort appears, many traders suddenly begin emotionally negotiating against structure. Maybe the stop is too tight. I'll just give it a little more room. This setup still looks good. It will probably reverse. And slowly, the stop begins widening. Not because structure changed, but because emotionally, the trader no longer wants to experience the discomfort of taking the planned loss. That is extremely important to understand because often, the stop movement begins long before the trade fails structurally. It begins when the trader realizes, I do not actually want to lose this amount. That is why position size matters so much psychologically, because position size directly affects emotional pressure. And emotional pressure affects behavior. Many traders think, if I just become more disciplined, I can handle larger size. But often, the position size itself is creating emotional instability. The stop amount becomes emotionally too painful. The nervous system becomes overloaded. And eventually, the trader begins modifying behavior emotionally to reduce discomfort. Not because structure failed, but because emotional pressure became too heavy. That realization changes everything. Because now the trader begins understanding. The correct position size is not the size that makes enough money when the trade works. It is the size where you can still emotionally accept the planned loss when the trade does not work. It is the size where you can genuinely accept the planned loss emotionally before entering. The size where you can respect the stop, tolerate fluctuations, stay behaviorally stable, and remain aligned with structure under pressure. That is your real size, not the size your ego wants. Not the size where the potential profit feels attractive, not the size where the potential profit distracts you from the emotional reality of the loss. The size your nervous system can consistently handle without emotional intervention. And honestly, many traders are trading larger than their emotional tolerance allows. That is why stop movement becomes so common. Because once fear appears, the brain naturally seeks relief. That relief can appear as widening the stop, avoiding invalidation, refusing to accept the loss. But there is another emotional stop-loss behavior traders rarely discuss: over-tightening the stop. Because emotional discomfort does not only appear during losses, it also appears during unrealized profit. At first, the trade begins moving correctly. Profit appears. The trader feels relief. Confidence increases. But then the market pulls back normally. And suddenly, the emotional experience changes again. Now the trader is no longer asking, is the trade structurally valid? Now the trader begins asking, How do I avoid losing this profit? That subtle psychological shift changes behavior enormously, because once unrealized profit appears, the brain often begins treating it as owned money, and now every pullback feels painful emotionally, especially in volatile markets such as Nasdaq, for example, where impulsive moves, liquidity sweeps, and aggressive pullbacks happen very quickly. And many traders begin emotionally reacting to those fluctuations without realizing it. They tighten the stop aggressively. They trail emotionally, candle by candle. They reduce tolerance for normal volatility. Not because structure changed, but because emotionally, they do not want to feel the discomfort of giving profit back. And sometimes, emotional overmanagement does not only tighten the stop, it exits the trade entirely. Because once traders begin micromanaging every candle, every fluctuation, every temporary pullback, the emotional discomfort becomes too difficult to tolerate. And eventually, traders leave the trade early. Not because structure failed, not because the trend ended, but because emotionally, they could no longer tolerate the uncertainty of remaining inside the position. And often, the move continues afterward without them, leaving behind frustration, regret, and the feeling of leaving money on the table, not because the setup was wrong, but because emotional discomfort became stronger than structural patience. That is another form of emotional discomfort management. And ironically, both widening the stop and over-tightening the stop often come from the exact same root issue. Discomfort intolerance. Widening the stop says, I cannot emotionally tolerate taking the loss. Over-tightening the stop says, I cannot emotionally tolerate giving back the profit. Same emotional root, different behavioral expression? That realization is huge psychologically, because many traders believe tightening the stop automatically means discipline. But sometimes, tightening the stop is simply fear wearing a different disguise. Now, this is important to understand clearly. This does not mean all stop movement is emotional. Professional traders actively manage risk all the time. They trail stops, reduce exposure, scale out, tighten risk, move stops to break even, and protect profit based on structure and predefined execution models. That is completely different psychologically, because structured risk management is not driven by fear. It is driven by planning, structure, volatility, context, directional confirmation, predefined execution, and objective trade development. A professional trader may tighten the stop because a higher low confirmed, structure evolved, momentum shifted, risk/reward changed, or the trade entered a new phase structurally. That is not emotional management. That is structured risk management. The important psychological question is not, did the stop move? The real question is, why did the stop move? Was it driven by structure or emotional discomfort? Because externally, both traders may look identical. Both moved the stop. But internally, one trader followed structure. The other trader escaped discomfort. Completely different psychology, and honestly, many traders unknowingly create emotional chaos by trying to aggressively manage every fluctuation, especially during fast impulsive movement. Because fast impulsive conditions create adrenaline, urgency, nervous system activation, fear of being wicked out, fear of missing continuation, fear of sudden reversal. And traders begin reacting automatically. Sometimes the trader tightens because the wick volatility feels dangerous. Sometimes the trader gets stopped quickly from an emotionally tight stop, while the trend itself continues moving. Now frustration appears. The trader watches the move continue without them, watches more profit happen without them, And emotionally, the urge to re-enter becomes very strong, not because a clean new setup appeared, but because frustration and fear of missing continuation begin taking over. And now the trader often re-enters emotionally, sometimes at a much worse location, while still carrying the emotional memory of being stopped out too early, which creates another psychological problem entirely. Because now the trader becomes even more emotionally sensitive about unrealized profit. The trader no longer wants to experience that frustration a second time, and conflicting emotions begin appearing simultaneously. Part of the mind wants to tighten the stop aggressively to avoid giving profit back again. Another part wants to widen the stop to avoid being stopped out too early a second time. And now the trader is no longer calmly managing structure. The trader is emotionally reacting to fluctuations in real time. Every candle begins feeling psychologically important. Every pullback begins triggering emotional decisions. And emotional instability starts escalating rapidly, not because structure necessarily changed, but because emotional discomfort is now controlling execution. Especially in volatile markets, where fast directional moves can psychologically overwhelm traders very quickly. Then sometimes another dangerous situation appears. The trader initially moved the stop because of wick volatility or emotional discomfort. But suddenly, the market structure actually changes. Now an opposite engulfing candle appears, a topping tail, a bottoming tail. Momentum shifts quickly, and suddenly the trader realizes, I should probably get out now. But by that moment, the move already happened fast. The loss now exceeds emotional tolerance, and the nervous system begins freezing. So instead of exiting, the trader says, I'll wait for a pullback to get out. That moment is extremely important psychologically, because often that is the exact moment structure gets abandoned and emotion fully takes control. Now the decision is no longer, where is the trade invalidated? Now the decision becomes, how do I emotionally reduce pain? Very different psychology. And sometimes, traders begin adding more positions while waiting for that pullback, averaging down, hoping only for a small retracement to escape the trade. But often, that pullback never comes, and one emotionally unmanaged trade becomes catastrophic account damage. Because once loss becomes emotionally overwhelming, the brain often stops making objective decisions entirely. Now survival psychology takes over. Hope replaces execution. That is how catastrophic losses happen. And honestly, many traders eventually realize something painful. It does not matter if you make $1,000 today. If one emotionally unmanaged trade destroys everything the next day, that realization changes trading completely. Because now the focus is no longer, how much money can I make today? Now the focus becomes, how do I protect myself during moments when my emotions become intolerable? That is a completely different mindset. And honestly, that shift may be one of the most important turning points in trading psychology, because traders begin understanding something deeply human. During fast volatility, during impulsive movement, during emotional overload, human beings can make mistakes very quickly. That is normal. That is reality. And this is exactly why the stop loss itself is so important psychologically. Because the stop exists, so you do not need to emotionally make emergency decisions inside chaos. That is one of the deepest purposes of the stop. The stop is not punishment. The stop is protection. It exists because during fast volatility, during impulsive reversals, during emotional overload, human decision-making deteriorates rapidly. The stop exists to protect the trader before emotional paralysis begins. That changes the relationship with the stop entirely, because now the stop is no longer something taking money away. The stop becomes the thing protecting you from catastrophic emotional decisions, protecting your capital, protecting your account, protecting your future consistency, protecting one emotional moment from destroying months of progress. And honestly, many traders begin realizing they do not necessarily need perfect exits. They need consistent protection. Sometimes even structurally trailing the stop may result in smaller profit, getting stopped out earlier, or missing part of the move. But it can also protect consistency, prevent catastrophic losses, reduce emotional escalation, and stop traders from becoming trapped during chaos. That matters enormously psychologically. Because consistency is not built through maximizing every move. It is built through surviving emotional moments repeatedly without self-destruction. That is why smaller, emotionally manageable size matters so much, because once the stop becomes emotionally survivable, the nervous system stops needing to interfere constantly. And eventually, the trader begins realizing the goal is not eliminating uncertainty. The goal is remaining behaviorally stable inside uncertainty. That is a completely different mindset, because markets will always contain fluctuations, pullbacks, volatility, emotional pressure, and uncertainty. And if every fluctuation emotionally destabilizes behavior, consistency becomes extremely difficult. That is why emotional tolerance matters so much. Not emotional suppression, tolerance. The ability to stay aligned with structure while discomfort exists. That changes everything. And slowly, through repetition, through smaller, emotionally manageable size, through honest self-observation, through pre-planned structural execution, through respecting the stop consistently, the trader begins changing. Not overnight, but gradually. One emotionally tolerated loss at a time. One pullback survived without panic management. One moment where structure becomes stronger than fear. Because ultimately, the trader you become is not decided by how much profit you temporarily hold. It is decided by how consistently your behavior remains aligned under emotional pressure. And if this message resonated with you, perhaps share it with someone else walking through the same struggle. And if you want more content like this, you can subscribe and continue the journey, because the trader you become is decided one decision at a time.